We sort of got off to almost a better start, even flow wise. And the reason I say that, yesterday we started to see signs that players were possibly going to get squeezed early on. And then just when flow got quiet, you had that Apple headline, and bears just grabbed the ball from that point and ran for the rest of the day. Okay. And you don't want to make too big of a deal out of any one-day move in a bear market today, yesterday, but we could see some signs of just tone starting to change. Okay, again, we have no idea what that results in as far as the upside is concerned, right? And the reason being is, again, because of the Fed tightening cycle. At any point, we can see this market test lows again, right? We could be range bound, and that's what I think possibly we're going to end up being anyway. All right, but because we can't quantify the upside, and I don't know, HC, you probably read it, McElliott's note yesterday. He's on the exact same page. The squeezes we were used to for bearish positioning, Vanna, hedge unwind, all that stuff is going to look a lot different now because of the Fed rigging cycle, right? And again, this is nothing new. We've been talking about this. And the reason it's going to look different is a lot of times you would wait for that unwind to completely work itself out, right? You didn't even need to put a target as far as a level is concerned on the upside. You would just wait for all that bearish positioning to unwind, and that would be the point where you would look to exit if you were positioned for a squeeze. Now, because the Fed has to lean on things and nothing has changed, at least nothing that we could see has changed out there, okay, as far as that's concerned. That doesn't mean the market can't have up days like today. Doesn't mean the market can't have an up week, all right? But as far as we know, the bottom line is the Fed still needs to continue to tighten financial conditions, especially if inflation continues to be sticky, right? There's no out for them, right? And beyond that, the Fed put is nowhere in sight. As much as people want to pretend it's there, right? The Fed put is not just a Fed pivot from aggressively tightening and draining liquidity to stopping, okay? The Fed put is when they come in and put in a floor, hence put, okay? They literally put in a floor where they're not going to let things unravel. And it's a level you can play off of, right? Into and off any selling and weakness in the market. That's the beauty of the Fed put. Okay, it's easy to quantify a risk reward when you have the Fed put in play, right? Now, without that in play, not only do we have a rough, a really cloudy gauge as far as any upside is concerned, just simply on even any bear market move, but the downside is, there's no floor there anymore, right? There's no floor there anymore until we see different. So that being said, okay, and you guys mentioned what Sentiment Trader posted, and enough people out there who follow positioning and sentiment like a lot of us do. It really got to the point, right? It got to the point where if this market can't figure out a way to at least put in a temporary floor, right? Forget about rallies, right? Forget about V-shaped rally to new highs. Get that out of your head. And another thing that I told you guys on the members only webinar that we need to start changing the way we think. Forget the word bottom, right? Are we at a bottom? It's only going to get us in trouble. Okay, it's only going to get us in trouble, because even if we feel with some conviction we are at some sort of bottom, right? 3 months from now, without the Fed in play, that bottom can disappear 1, 2, 3. Okay, so we need to get rid of the thought of, are we at a bottom, until the Fed or are there any signs that the Fed is going to stop rigging this game to the downside? Okay. The same way on the upside, when the market's raging higher, and the one thing you need to never do when the Fed is rigging the game to the upside is try to pick out tops. You'll go broke, right? Why? Because the game is rigged, right? You can't apply logic to it, right? The game is rigged. The Fed is continuously pumping liquidity into the system. Interest rates are extremely low. There's cash all over the place. People buying everything from jarred farts to NFTs. The system is flooded with money. Tops are a losing proposition, right? And that's the way we got to think now as far as bottoms are concerned, until, again, we start to see even just signs that this Fed rigging cycle may be out of the picture, okay? And right now, it's not. It's nowhere the end for us, right? And we're limited to what we see. We're looking at what everybody else has access to and looking at, okay? For what we and everybody else is looking at, the rigging cycle for the Fed is nowhere, the end of it's nowhere near in sight for us. There's not even any hints of the end of that thing coming, right? Inflation is still elevated and sticky, and still, even if it starts softening a bit, we spoke about this thing's going to linger. This is not something that if inflation or the CPI, a headline number, comes in a decent way, the Fed could be like, all right, everybody, we're cool. We're going to stop tightening. We're going to start draining liquidity. We're going to chill out. You know what? Well, maybe we're even start pumping QE into the equation sooner than later. You think the Fed's going to do that? And then risk assets rally to new highs, and Bitcoin and NFTs and all this other shit starts flying all over the place again, right? And God forbid inflation comes back into the picture. It's not going to happen. It's not going to happen. So what we see right now, the Fed pivot or the Fed put or any of that stuff is nowhere in sight. So the word bottom, we have to get out of our heads. Okay. I think I drove that point home. It could only get us in trouble. But we got to a point, and this is what we spoke about on the Sunday webinar, where positioning is so freaking lopsided, okay? What you and I have been talking about and are talking about right now, okay, in regards to the Fed and how they're rigging the game, is obvious to every schmuck officially now, every schmuck out there, okay? It was obvious to everybody. You started to hear every mouthpiece come on Bloomberg and CNBC start talking about how upside is capped because of the Fed tightening cycle, okay? So it became so obvious to everybody, to the point where when you look at not only just sentiment, but positioning, okay, it got to a point where it was so bearish, okay, outside of capitulation, right? So as bearish as you can get without everybody throwing in the towel and leaving the market for a long period of time. Okay, that's how bearish it got. To where, if you look back throughout history, and as long as I'm in the market, 25 years or whatever the hell it is right now, I don't even know what year we're in, you usually find some sort of floor, okay, where it allows some of that positioning to even itself out, okay? And we're going to look at some of that stuff today. And in my opinion, the reason why I think this market got a little, excited to the upside today is because of what, the note that came out of BOVA. A lot of eyeballs, including HC, who was asking me about it recently. Funny, HC, you just brought it up to me last week, and it came the following week. But a lot of eyeballs were waiting on to see how this BOVA Global Fund Manager Survey, how it was going to look coming out this week, right? Because people were expecting to see suicidal thoughts across the board there. It came out this morning, and even Hartnett, right, who has been on the money, He's the creator of the bull bear indicator and the flow show and all that stuff. He's been on the money. It was so bearish to the point exactly where he titled it, we're so bearish that you have to be bullish here. Okay. You have to, that's how bearish that, or the whole positioning and sentiment part of this game got. Okay. And again, there was a disclaimer in it as well, right? Where, listen, don't get too excited about it. You can get some sort of squeeze. You can get some sort of bullish bias trading range, but ultimately that's more than likely just to offset some of this positioning. And then at the least, we got to wait and see, where everything stands at that point, in regards to the Fed. All right. Because the problem is, if you didn't have the Fed doing what they're doing right now, okay, this is something that you would dive into. This is the type of setup you would dive into. You would dive into, even without capitulation, even without fund flows capitulating, right? Because that's ultimately what you want to see. That's the last chapter we talked about, where you get that V-shaped rally in a sense, right? Even without that, as dire as positioning, looked coming into this week, this is usually a setup you want to dive in, and worst case scenario, you get a half decent trade out of it, because like I just said, the downside is limited over a short to intermediate term basis. Why? Because everybody's positioned bearishly. You understand? No, there's not a lot of selling that's left unless something breaks, right? You get that exogenous event, which you can't rule out these days, all right? But unless you get something like that, you usually find some sort of floor, and you can trade off of it, type of thing. I'll give you an example. 2008, if you remember, I think we were looking at it on this webinar, right? We scrolled back and I showed you that period of time, ironically, right before the wheels came off, and I officially went into my bunker in 2008 and hid from everybody and took my cash and put it under my mattress and didn't know what was going on in the world. Right before that, there was a relief rally in the sense, right? It didn't feel like a rally as it was going on because there was still volatility. A lot of rallies would fail on a short-term basis, but net, we held lows and there was a bullish bias, right? You could have made some money on the long side, one of the few times in that down cycle. All right. But ultimately, all it did was get people to think that, or position accordingly, that it may be the bottom, relieve some of that bearish sentiment, and then nothing changed fundamentally. Things got worse and the wheels came off, and the global financial system as we knew it was, it was Armageddon, right? So that's kind of where we're at here. I wouldn't, I don't necessarily want to compare it to 2008. 2008, you already had things going out of business. What's different about this current situation we're in, you got a lot of sentiment that's pretty beat up out there and really washed out. And the economy really hasn't deteriorated in a meaningful enough way yet to justify the sentiment. Did I confuse you more? Or you understand what I'm saying? In 2008, when we were at this point, it was scary. You had major brokerage firms and banks going under. You know what I mean? Like credit, was starting to freeze up and lock up in areas. So there was more things to be concerned about as far as the economy and the plumbing of the financial system than we have now. Now, to this point, the Fed can't complain where they're at because we really don't have, we haven't had anything bust yet. You know what I mean? We haven't had anything really bust yet. And the likelihood is that's still to come. All right, but so net, the way I'm looking at things and the way we were talking about it in the steam room, because of the Fed preventing, right? The last thing they want here is any significant rally in risk assets. Okay. We've had a legitimate correction from the highs. It gives some, it allows some room for upside, right? Like we were saying, you know, this ES or S&P 500, can it get to 4,100, 4,200? Yeah, it wouldn't be the end of the world. But at that point, the likelihood is the Fed's going to have to put the kibosh on it. You know what I mean? They can't allow it to get any crazier than that, in a sense, if they want any shot in tackling inflation without it biting us in the ass, if it hasn't already, right? So that's, and if you look at it, right, that's best case scenario. And if you want to slap odds on it, I don't know if they're that good. Let's say 4,200, even where positioning is at, right? Where I think where you find better odds, okay, is if you're looking for those, again, that T word, those tactical opportunities, right? You put your trader's cap on, you size down, you try to get through this period by looking for entries into weakness, right? And looking to catch that snapback squeeze of those shorts and that bearish positioning out there. Okay, because the logic is, right? The logic is this. You have enough, especially on the professional side, that are positioned on the short side, CTAs, hedge funds, systematic funds, all sorts of things, right? What will happen is if you get some sort of choppy, range-bound market here, right? And even if volatility is kind of in check, okay, you're going to have where you see any weakness in the indices, they're more than likely going to cover shorts into the weakness. You understand? Which creates those squeezes. So it's really difficult unless you get something breaking out there, right? Again, it's possible, but you know, they're rare. And when they happen, it's usually the last phase. Unless something really busts out there, it's really to see that selling accelerate and snowball into something bigger from here without them offsetting some of the sentiment out there. So, you know, in simple English, you plan for a range-bound market, right? You try to cut down your time frame as short as possible. And, you know, your best odds are into weakness. Like I give an example with this market right now, okay? We're going to learn more about this market, even being earnings season and everything else, right? We're going to learn more about this market as soon as some selling comes into the picture, right? That very easily can happen tomorrow, right? If not overnight. But literally, there are plenty of bulls in the air right now with Europe and Draghi resigning and earnings and everything else, where you can see futures overnight take a hit. We come into the morning, the indices are down, they open up lower, and we're going to have the ability to see if any buying comes into that, okay? Because if we are in this new phase to wear out some of that bearish positioning, what we're going to see is we're going to see buyers show up into that weakness. That's going to be what we start to see, that constructive sign that we start to see where things look a little different, all right? We're going to start to see that dip buying come into play again, right? The sells a rip is still likely to be there, but what's going to be different this time around is you're going to see buyers interested into weakness, because again, they're not just buyers per se. You got people who may think we're putting in a bottom, that inflation has peaked, right? And like I just mentioned, you got plenty of shorts out there that are going to need to cover and take off risk. Okay. And like I said, the more you have a more bullish bias here, right? So sort of higher lows, uptrend, VIX intact, right? Not getting too crazy. The CTAs and all the systematic funds that have taken down their risk so aggressively to basically they're short and have been sitting short, they're going to need to cover. You know what I mean? Systematically, they're going to need to put on or take their exposure of risk they're going to need to elevate it. They need to take that higher. All right. So that's what we should start to see and see signs of if this little range bound / bullish bias is in play. And we should see more opportunities, especially on the individual name level. Okay. Hold on a second. We should see some more opportunities on the individual name level. All right. That being said, I just want you guys to see, especially what came out today, so you know exactly what the hell we're talking about here. Where's how the likes? Where's my likes? All right, this is it. Ooh. Did you guys? A lot of you guys saw this already, right? I'm sure if you members, you saw this already. But this is just the headlines here, and you get the gist of it. Fund manager survey shows dire level of investor pessimism, expectations for growth and profits, all-time lows. You're talking about Lehman Brothers lows. Cash levels highest since 9/11. Equity allocation lowest since Lehman. The bull bear indicator, which we spoke about, has been floored at 0 for multiple weeks now. Okay. Fundamentals poor, but sentiment say stocks credit rally in coming weeks. All right. I mean, we can look at some charts here. They're pretty crazy here. Here's recession. Players thinking there's a recession, right? You got that major spike. I mean, the R word's being thrown around all over the place. Global growth optimism, you're all the way down here now. Okay, look at that rollover. Global growth, what's this? Oh, global profit optimism, new lows. Want CEOs to reduce debt, not increase capex, or so risk on sentiment, right, amongst corporations, down the toilet. What else we got here? Lower inflation expectation mean lower interest rates. Nobody expecting that. Inflation, the key driver of the Fed pivot. Well, that's obviously a given. Investors no longer expect higher bond yields. Look at that. Everybody thinks the end is near, basically. Ooh. Cash levels highest since 2001. That's pretty intense. No? That's pretty intense. 2001? That's the dot-com bubble. That's 9/11, by the way. I remember when cash was at that level. It wasn't even the dot-com bubble. It was 9/11 that followed after the dot-com bubble. Think about that double whammy. It's so funny, Stephen. Everybody is chewing on it. Everybody who likes to follow this stuff like we do, Stephen, that's exactly the question everybody's chewing on. Everybody. Okay. And the simple answer, the pros, okay, who are obviously, and I don't mean this in a demeaning way, okay, even though it probably is, but whatever, are more knowledgeable about all the fundamentals to the game and the economy, right? They're more aware, they're more on top of things. Okay. They de-risked a lot earlier, Stephen. They really have taken down risk exposure almost at a gradual pace early on in this bear cycle. It wasn't like bang and they went from long to short, right? Remember kind of like what we've seen from the hedge funds. Okay. They got negative and more negative, more negative. So they kind of got a head start in the process and avoided a lot of pain by doing it. Okay. The retail player, especially the more passive investor, has had a different outlook on it, right? Because you think about these are players, and they're not even players, these are investors who, when they put their money in, are looking to weather the storm when things get rough and utilize time to get through the rough patch. Okay. The inflows were so large, okay, and which makes it look even more, extreme in a sense, but they just haven't reached the point yet where they've given up on equities. And think about this, Stephen, just think about this, okay? And my buddy mentioned this to me, and he's 100% right. If we bottom right now and we start a new bull market, you think investors are so disgruntled that they won't come back into the market? You think they're at that point yet? I don't think so. I don't think so. At CNBC, every 5 minutes, they're asking somebody, are we at a bottom? Every 5 minutes. Every 5 minutes, somebody, that's the most popular question in the world right now. Have we bottomed? You know, when you see that, when that fund flow comes out, no one's asking, have we bottomed? Trust me, nobody's asking, have we bottomed? They don't even want to know. You understand? They don't even want to know. Give me my money, whatever's left of it, and leave me the hell alone with this effing stock game. I want nothing to do with it. That's usually the end. That's how it ends. That's how it ends. And if you look back, right, those fund flow charts, look back, we post them constantly, you could see it play out where they get out and they stay out for a lengthy period of time. They don't come right back in, right? Because they're so disgruntled. When they came out in 2008, you know what I mean? It took forever to come back in, years, right? When they came out in 2001, years before they came back in. We're not at that point. You know what I mean? We're not at that point. Yeah, and it's like they were almost forced in by the global pandemic because, you know, the government gave them money and they got to open up a Robinhood account, you know? But those are more traders too than anything else. I'm talking about the passive investor. Those are what the fund flows really resemble. They're not the traders, the option players that we see. A lot of them have caught beatings. A lot of them have been knocked out of the game. But still, I think if this market bottomed right now, there'll be some that come, not all, but there'll still be some that would come back. Exactly. Some would still be scared, but some would come back. You know, so that's, again, there's no science or back testing numbers I can show for that, Stephen, but that's like me and my buddies were talking about it. And that's how we feel. Like that we're not at that point yet. And that point's going to come, like I told you guys, you know, not trying to scare you, but the last few webinars, just to make you aware of that the likelihood is when we do finally bottom, okay, it's going to be really ugly out there, you know, and it's going to be so ugly that people are going to leave the game and want nothing to do with it. That's how ugly it's likely going to be, you know, and it's just not that there's individual stocks that are that ugly, but the economy and even pockets of the investments aren't that ugly yet. I mean, this economy is nowhere near ugly yet. You got full employment. You got too many jobs out there. How can it be ugly? You know what I mean? Like there's still, everybody's got money. Everybody's got money in their pocket. It's easy when you have money in your pocket. You know, when you don't have a job and you have no money in your pocket, things change drastically. So anyway, again, if you remember, as we're going to look through this numerous times, you can look through it on your own. These things got really, really out of whack. And they've been out of whack, but they got to the point where here's the thing that changed coming into this week. Okay. And I just want to make the disclaimer. Okay. I still don't have the confidence to hold overnight positions. Okay. Even with positioning this bad. Okay. Because of what the Fed is doing. God's honest truth. Okay. That on top of there hasn't been any clean buying that I can pick names from, but even outside of that, okay, because of what the Fed is doing, the reward part of the risk reward equation is so skewed that I still don't think it's worth it to hold a basket of overnight longs, right? You want to roll the dice, and you want to buy some Amazon calls for a run up a couple of days before earnings, that's a different story. I'm not saying you have to be that scared. If it's just going to be a loser, it's a loser. You don't worry about it. Okay. The point I'm trying to make, and this is so I drive the point home to everybody to understand where I'm coming from. The point I've been trying to make for a lot of this bear market to the downside is getting buried in a basket of long calls. Okay. You may think you have some sort of risk management strategy that you'll get out, stop loss, this and that. In this type of market, if you're long a basket of calls and you're not okay with them going to zero and losing that money, they're gonna knock you out. They're gonna knock you out. It doesn't take long. 1, 2, 3, boom. You know what I mean? It takes one little bust up overnight, and you wake up and there's nothing left of those calls. So, that's where when we reach a point where when we feel the conviction for quote unquote the bottom, that's what we're ultimately saying, right? That we want to start building positions in names, and if we're a little bit early, we want to look to take advantage of that weakness and add exposure. Okay. We don't want to add exposure if we still have legitimate downside risk, right? And that's what I'm saying. I go back to the risk reward situation. The upside is limited and the downside is what? I don't know. How do you put a number on the downside? How do you put a number on the downside right now? You know what I mean? You can't put a number. And going back to the fund flows, if that comes out, right, you're likely gonna have some supply hit the market. There's very, very good chance it can weigh on price action in a pretty decent way. Where? What? 3,500, 3,000? Right? You can pick a number out of your ass and start buying. Yeah, and that's why, like Ranchero, all kidding aside, Hartnett, right, who's basically the author, the guy who writes up all this stuff, the Bova stuff that we follow, the Flow Show. I think his strategy, if you want to pick a level, right, to start piecing into, kind of like Ranchero, like you like to do, piece into it. His approach, I think, is the best thing out there that I heard. All right, and basically his approach is this. I may be off on the exact numbers, but 3,600. You start nibbling, right? 3,300, you start adding a little bit more. 3,000, you start to get aggressive, right? So if you put a gun to my head and said, pick it like a downside level of where to start legging in without seeing what we want to see, right? Some of the constructive signs we want to see, I would recommend that. Otherwise, what's the rush? What's the rush? That's the question you got to ask yourself. What are you missing? The start of a rally? What are you missing? Right? If sweepers aren't bombing names, right? Clean action. I'm not talking about earnings bullshit, excuse my French, right? If sweepers aren't accumulating individual names, right? And there's still max long fund flow out there that if you backtest that, throughout history, there's never been a V-shaped recovery to new highs without fund flow capitulation. What are you missing? Where's it going? Are you afraid this market's going to go to new highs and go parabolic in the face of the Fed here? You know what I mean? Is that what you're afraid of? Like, otherwise, what are you missing? A little rally? Who cares? Every rally falls flat on its face. You get destroyed. Think about any rally you attempted to play in this bear cycle. That's the thing you got to keep reminding yourself. We want to see some really constructive signs before we get to the point where we're going to start building baskets. Okay? We want to see some constructive signs. And as we're building those baskets, we want to see more and more of those constructive signs show up. You understand? And that's what allows us to get even more aggressive. You don't want to start doing it before you see that stuff, because again, we're pulling numbers out of our ass. No one could quantify it. Nobody knows, right? Again, there's no Fed put. Where are you getting these numbers from? A chart? Okay, whatever worked on the chart when there was a Fed put doesn't work anymore, my friends. Doesn't work anymore. I got news for you. Just like a lot of the shit we look at that worked when there was a Fed put, right? If we had this type of sentiment, even before we got to this point, and all you guys can vouch, we would have a bear market squeeze like we've never saw before. No? With negative gamma and sentiment indicators sitting at zero, we would have had a bear market rally over the course of weeks that would have ripped the bears a new ass. We're lucky we get a day of upside. It's different. It's a rigged game. You know? Yeah, because the game's rigged, Derek. You know what I mean? It's hockey sticks across the board, Andrew. Hockey sticks across the board. But listen. And I'm the first to admit, and I put myself in this category, we can't predict the future. We don't know. But Friday, something in the financial plumbing can burst, and the Fed has no choice, okay? Because we're heading into a depression, and they got to implement QE. What are we up to, 5? You understand? We have no idea. Anybody who tells you they do is full of poop. No one has a clue how this is going to play out. The Fed doesn't have a clue, for Christ's sake. The Fed doesn't have a clue. You know, like, look what's going on in Europe now, right? You got the ECB, who's got bigger issues than the Fed does. They have a major war, right? Which the threat of depression and inflation are probably at even odds. Think about that for a second, right? They got food shortages and energy shortage and electric shortage. I mean, you can't make it up what's going on there. You think the ECB has a clue of how this is going to shake out? They don't even know what to do about it, right? They don't even know what to do about it. My brothers and sisters, this is a different time. Trust me when I tell you, it's a different time, okay? It's a different time. What makes it so different, again, is because once the Fed stepped in 2008 and came in and rigged the game, okay, and they had to. There were people, we had this discussion. There were a lot of people who said, don't do it. Once you do it, there's no turning back. Let everything burn to the ground and the free markets will work themselves out. People will come in and buy stuff because they got too cheap and they'll put a floor in. But there would have been a lot of damage, right? So they tested the waters with Lehman Brothers. It didn't go well. And then after Lehman, Paulson and Bernanke, they shit a brick and they had to throw in the kitchen sink and do anything in their power to rig the game. Okay. But once they did that, okay, there's no out. You understand? Like here, right now, is the out with the Fed. They know they got a thread of needle here. They know it's nearly impossible to drain liquidity because we have inflation to worry about. They never had that to worry about. If you don't have inflation, you can keep doing what you're doing. No one bothers you. But once inflation gets into the picture, now the Fed has to hit the exit button. The exit strategy. There's no legitimate exit strategy. Okay. What happens is they're going to drain liquidity. They're going to tighten financial conditions to the point where it hurts the global economic system enough to where hopefully it tames the inflation. That's the strategy. But what do you think that does to the economy's fundamentals and to corporations and to everything else? You know what I mean? That's damage, collateral damage. Exactly. And Eric hit the nail on the head. That's the likelihood is that's how it's going to play out. It's going to seesaw from one extreme to the other, right? So that's why I'm saying, like, Lulu, when we get so depressed, like there's no light at the end of the tunnel, one thing about this game, it gets faster and faster each and every year, lightning quick, these cycles. That's even what's his name from Morgan Stanley, who's been bared up. That's what he said, Mike Wilson. Okay, it's not going to be, the process is not going to be as long as you think, because things can deteriorate quickly. And that last chapter, when shit hits the fan, that's when we're close to the end, you know. But in the meantime, a lot of us want to play, right? There are opportunities out there. There are definitely opportunities to try to make some money. Okay, you got to be realistic. You got to grind it out, right? All the stuff we spoke about. Your win-loss ratio is not going to be nearly as efficient as it's been. But net, if you can survive and make a little money in the process and still be around when the turn comes, there's nobody better than you. There's gonna a lot of people are gonna want to be in those shoes that aren't. You know, so that's what we're looking to do now, right? So that's what we have in front of us right now. We have players acknowledging that the system is rigged to the downside. Finally they swallowed that pill, like we said, okay, and they positioned for it. And now, based on the track record of the market gods usually like to make them feel some pain, right? It's usually not going to be a comfortable ride for them when they position that way. And like here, I'll give you an example, right? You guys can look at that whenever. And like Sharpies, that's what they're positioned for. You know what I mean? Same thing. What? Oh. Okay. Fed not rigging the game, right? Or we have total capitulation. This is an unbelievable buying opportunity, right? Always is. Doesn't even have to get there. Okay. Here, we got a different ball game. And like, look here, right? See this? They would have got squeezed to death on that. They got squeezed a little bit. That was this rally here, all right? And then a whole new start of a downtrend there. All right, so here they are now. They're deeper short, okay? They've been reluctant to get net short. They've been doing their jobs, hedge funds. They've been staying hedged, okay? They've been staying hedged. What they've been doing is buying SPX and shorting NASDAQ names, right? That's why like net put delta on the SPX is ridiculous, right? So they've always been hedged. So here, just recently, right? This laid down right here. You remember when we were looking at, I think it was Goldman, the note that said hedge funds, the last time they got this aggressive on the short side was that bear market rally in 08. All right, this laid down, they took the needle. They want to make some money betting on the demise of the market. All right, so the odds are that there's some sort of little floor here where they need to cover into, something like this again. So now it's up to us to try to figure out not only the best way, but with the least amount of risk. That's the trick, right? Because the last thing we want to do is take major risk right now. That's the most important thing that we have to pay attention to. We're looking to stay alive, right? Enjoy the process, maybe learn something, and God forbid, we end up in the green in the interim. But we got to figure out a way to make some money off potentially something like this happening. Okay. If you want to be ultra conservative, okay, my opinion, and I wouldn't recommend it if I didn't think it was worth it, is on an intraday basis. Okay. It gets a lot more difficult with options as opposed to equity, right? Because you can really manage your risk on like ETFs and equity with stop losses intraday. Options, premium drain, spreads, all that stuff. But anyway, a lot of you guys are familiar with that anyway, so you know what you're doing. But on an intraday basis, okay, the risk reward, that's where it's best. You can manage your risk appropriately, and there's upside. Some will be small trades, right? You make a little bit of profit, you take your profit and run, the market keeps going, whatever the case. But there's also the possibility you raise that stop and that market goes red to green, and now you got a nice hit. And I'll tell you what, last week there were a handful of those jammies. There were a handful of them. Who's that? AC, what are you talking about? This? Yeah, they bought into this squeeze. Right? Is that what you're talking about? Yeah. That's what it was. More short covering this here. So that's what I'm saying, like right here. This, where was this? Oh, this was here, right? What was the date on that? That wasn't the big squeeze, right? This was, I think. Yeah, it wasn't that big of a squeeze. But what I think, this is just one of the things. What I think the difference is this go around, AC, is that, again, the upside, I don't know if it's going to be any bigger than that or, greater than that. But I think the lows will find a bid. You know what I mean? Like we should be able to stay in a range for a longer period of time. So again, giving you an example, every market's different, but just so you get a picture of what I'm talking about. If you go back in 2000, the bubble blowing up there, or 2008. By the way, Ani, your little tip over there to put in the dates doesn't even work for me. They make my life difficult. Yeah, maybe, but I wouldn't chase green. I would not, like, you see, like a day like today, I wouldn't, we open up higher tomorrow, I would not chase that. I would not. If you're going to play intraday, worst comes to worst, it's a stop loss. But especially if you're not playing intraday, I would not chase. I'm not even for intraday purposes. If we open up tomorrow, I'm not chasing that. Unless it's a name that's down or something like that. But I'm not chasing green because I still think there's going to be these volatile swings out there, and I think we're going to get our opportunity into weakness. And I think, honestly, it's worth waiting for the weakness because you're going to learn more about the health of this potential range or, intermediate low, whatever you want to call it. You understand? Because I'll give you an example. And we've seen it in bull markets all the time. They're going to sell them. You're going to see the market weak. Okay. The likelihood is put sweepers will probably dry up. You won't see them as aggressive. And what you will start to notice is that call sweeper activity that comes into the red. And give you areas of, windows of long entries. So here's an example. Yeah, this icon, watch what happens when I press it. I'll kill somebody. Now it comes up. I did it for the past 5 days. Nothing would come up, Ani. Maybe I needed to reset it, refresh it. Unbelievable. This is funny. See, it makes me look like an idiot, right? All right, so look, this works a lot better now. Oh, much better. All right, this is the 2008 debacle, right? Again, this is 2008. I'm not saying we're 2008, but just to give you an idea. Okay, this was one here. We didn't have this during this down cycle, nowhere near it, right? But this was one area where sentiment really got bared up, right? You see that double test here, held, and then this, right? So this is kind of what I'm talking about. And even more so, I think this might have been better than the other one, but anyway, here's another one. So you see, this doesn't look like much at all, right? You see how it's just like a grind range bound type market for like a month, is it? Or 2 months? 2 months? And then rolled over, and that was game over. And then here, you had another one here where we even pierced the low, and see this? So what happens is when you get sentiment to the point like similar to where we are now, okay, even though you don't get that squeeze, the process of this wears out some of those bears because they're already on edge. You know what I mean? Because again, the charts don't do it justice. The up days feel like today, like the market's going to rally to new highs, where you can't even see them on a freaking chart, right? Like you felt how bullish today felt. I'm sure there's some excitement out there. Sharpies, believe it or not, Sharpies, they got long once in 2008. It was this here, I think. And then they got short into these highs from one extreme to another. I think it was this. There might have been this. I'm not 100% sure. One or the other. But yeah, they did it once. They did it once. And here, you know, very similar. They did it. Actually, this is the second time they did it. They did it once into the bigger squeeze, and they did it as literally into the squeeze, where now we haven't squeezed as much, right? So Sharpies here, they started taking off their hedges and then got more aggressive into the rip, right? And then here they started putting back only some of those hedges. So now down here again, they've taken off not only all their hedges, they're even more net long exposure than they had over here. You know, so very similar, very similar. But even with Sharpies, you'll see how, you know, with the different indexes, how they've been moving things around. It's not as clean as we would like it. You know what I mean? It's not like they removed all hedges. They're removing all hedges across the board on the index level or getting net long. Like this is the first time since then they just got long S&P futures, S&P 500 futures. You know, they've been net short S&P 500 futures throughout. So it's been, listen, it's been a tricky market. You know what I mean? It's been a tricky market, especially for, you know, what they need to do. They need to hedge positions. This has been one of the most difficult markets to hedge properly. You know, VIX is dead. Everything is dead. You know? So, you know, that's the story. I mean, yeah, maybe we break out a little of this downtrend, you know, test a high somewhere. But you got to be careful. You got to be careful chasing. You got to, this is what you're hoping for. You know what I mean? Yeah, again, if overnight, otherwise intraday, any red, any weakness, you see some sweeper activity into, it's worth a play. It's worth a play. VIX, yeah, well, here's the thing. And we were talking about this today in the steam room. It was, I really, from the beginning of the morning, I didn't think they had a shot in rolling over VIX because you got a lot of things going on here. As a matter of fact, I think you're going to start to see VIX turn higher here soon. You know, I don't like this week with Europe and all. You don't have VIX moving higher. I don't know. That doesn't make sense to me. And then into the Fed event, VIX usually moves higher ahead of it, and then you get the Fed clearing event, right? VIX rolls over and you get a squeeze. Honestly, if for swing trading purposes, that I mentioned it in the write-up yesterday, that would be the ideal setup if you were looking for a worthwhile swing trade, my opinion. That Fed clearing event rally, you know? And what that would consist of, like, let's say if it was going to play out from here, you get chop, right? So this rally kind of fails a bit and you back down into the range. You get a VIX elevating, you get put to call ratios elevating, right? And then once you get to the Fed, right? If you know what happens after the Fed event, usually no matter what happens, VIX rolls over, put the calls roll over, and you get a squeeze. You know, and it's usually worthwhile enough to play if you have all that line up. Yeah, VIX positioning in general, even on the hedge fund front, very quiet, very neutral. So you got Sharpies. They're always a little long VIX futures. They still are. No signal there. You know, you want to see them get short VIX futures. That's usually into a pop almost always. And hedge funds, they're doing nothing. As a matter of fact, I think they shorted a little VIX futures recently, but nothing major. Nothing major. You know, because you haven't had again that word that and everybody's looking for it, guys. You know, we're all looking for it. When everyone's looking for it, it almost never comes. Capitulation. And it almost never comes. Right? How could you get capitulation when everyone's looking for capitulation? The people looking for capitulation are the people who are going to capitulate. No. You understand what I'm saying? Right? Everybody who's looking for capitulation is probably going to capitulate into capitulation. They're not people sitting there looking for capitulation. It doesn't work like that. It doesn't work like that. So we'll see. The other thing too that like I've given thought about, like, I don't know, like the upside of this rally, bears want an entry. The market's going to give them an entry. You know, I guess maybe there's enough shorts that they could run them over here, that they're not concerned about that. Yeah, I know Druckenmiller's looking for an entry, right? You know, he'll be shorting the equity market. We get a meaningful rally. Yeah. It's funny. Druckenmiller, you know, he's more scared to short than go long right now, as a matter of fact. You know, and while people have dipped net short, Ani not only scared stiff to play either side. I think that's the main issue with this market. You know what I mean? Both sides, I think there's just as much risk right now. That's the problem. That's the problem. Oh, I know. Trust me. I know. But, you know, listen, we take enough risk when we have things on our side. You know what I mean? You're always taking risk in this game. It's not like when things are bullish, you're going to print your own money. You guys know that. It's not that easy. You know what I mean? But that's the risk you want to take. This is the risk you got to try to avoid. This is the risk that knocks people out of the game, man. This is the risk that knocks people out of the game. You know what I mean? It's tough. It's tough. But, you know, nothing has, what has changed? Like, besides positioning right now that could put in a floor, right? Big picture wise, what has changed here as far as what the Fed is doing? Anybody have any suggestions? I'm being honest. Like, anybody see something that I don't? You know, and here's another thing, okay? And I'm telling you from experience, I don't know how people forget so easily, or maybe the problem is they've never been in a bear market. That's the problem, okay? Because everybody I talk to seems to be aware of it. Everybody assumes that every time the Fed cuts rates, it's all in, buy as much as you can, and don't worry about a thing. I got news for you. Some of the worst price action that I've been a part of have been when the Fed was cutting rates. How about that? Okay? How about that? Why? Because think about why they're cutting rates. The wheels are coming off. You know what I mean? The wheels are coming off. So it's not always, you know, oh, the Fed's going to cut. Let's, like, think about that. Like, that's what bulls are looking at right now. Let's front run the Fed needing to pivot and buy ahead of the deterioration. I don't see it, guys. Yeah, inflation is the root of all evil because the Fed can't stimulate. You understand? The Fed can't rig the game properly. When you don't have inflation, every correction's viable, every single one. Yeah, the Fed's got a lot of work to do. You know, listen, forget about cutting rates. Like, things got to get a lot worse before they do any sort of cut rates or QE. We're not even in the same world with that. You know, could they be closer to a pause? Possibly. But like, what that rally or that little uptrend that's created off a Fed pause, how far is that going to go? Can't go too far. The Fed can't have it go too far. You think they're gonna come out and be like, listen, everybody, we're pausing. Get long all risk assets and make sure you buy your boob sweat and all that shit too while you're at it, and create another bubble while inflation's still hot. I think, guys, best case scenario when we reach a point of better things, it's not the better things everybody thinks of. You don't have to be afraid of missing out that FOMO. I think we're going to have multiple, when I'm talking about when things are good again, I'm talking about, we're going to have multiple opportunities for entries off pullbacks and weakness. Something we couldn't imagine during the bull market of the Fed put, right? There were no pullbacks. You know what I mean, though? I think, like, I really do think it's going to be almost, it's going to be like a range-bound hockey stick. Like that, I think that's the best case scenario right now unless things get worse, right? So if you want the V, we got a lot more work to do. But you want, near what's closest to us, glass half full, hockey stick. All right? Hockey stick. This. And this hockey stick, you're going to have a lot of things doing that. And, a lot of us won't mind that. A lot of us won't mind that. Twofold. One, you have any confidence in your trader skills and your discipline where you're looking for decent entries? That's your game. Okay. It's not going to be the riffraff game on Twitter where they can buy Amazon and then sell it and then $10 higher than where they sold it. A week later, buy it again. Right? They're going to get mangled. But for those of you who, are disciplined, been working on discipline, looking for good entries off pullbacks, that sort of thing, that's music to your ears. And even if it's not, while a lot of stuff and the overall indexes are in that hockey stick range, there will be leaders, new leaders, who are in uptrends and outperform. So you can be a stock picker again, right? You just don't buy FANG because everybody in their schmuck's mother's buying FANG. Or just buy GameStop, so. And that's it. I don't necessarily think they get smoked. I think the higher probability they go dead. You know what I mean? I think they go dead for a while. Some of them have been dead for a while now. No? Like these things have been dead money. But they can go dead. People forget Amazon was dead money for quite a while when Bill Miller was buying those leaps. Where the hell's that? That's over here, right? Back here. So how long is that? That's only a year and a half. Year and a half. But it was even before that, wasn't it? When Bill Miller bought those leaps? I don't remember when that. No, maybe it was that. Yeah, exactly. That's what I'm saying. There are different types of players out there. There will be opportunities for different types of player. You can't, unless there's QE, you're not going to be able to play the way the riffraff were playing, right? And let's be honest, every single one of us who have been in the game for a while, it's not the funnest thing to see. You put in all the work, all these years, all the experience, you work on your discipline, you're looking for weakness off entries, and Joe Schmuck on financial Twitter is just gassing up some SPAC name and loading up because he likes the symbol and changes his Twitter handle to SPAC Jesus, and he's outperforming. Yeah, exactly. Those periods come and, they go and they go. But listen, again, I don't know, I'm guessing. I don't know. The only thing I can relate to anything like this is the 2000 bubble. Okay. And even though there's some similarities, there's not a lot of similarities, but the NASDAQ 2000 bubble, when it blew, they went dead for a lengthy period of time, tech and growth. It went dead. But like I told you guys, from 2001 on, if you stayed away from those popular tech names, it was a lot of money to be made. A lot. No, well, I'm sure they'll find the money, to make up, but there won't be as many, that's for sure. Maybe, Eric. I can't figure. Well, AMC could have beaten. GameStop, I can't figure out. Me and Silver talk about it every day. I can't even talk about it anymore. I can't. I can't figure it out how this thing is where it's at. I really can't. But that's the market for you, right? If you could figure out the market, I wouldn't be sitting here talking to you guys. No offense. Yeah, Cal, those names, like you talk about hockey stick, they're already deep in the hockey stick price action already, Cal. No? Like, give me a name, any name. What's the skills? That was a beauty. Skills, even though they got the best symbols. You see this? Like, this is hockey stick on steroids. This is like Alex Ovechkin's hockey stick. Look at this. Now there'll be a few that survive. There'll be a few, but the majority are done. Oh, Wish, forget it. That was done before it was born. This Wish. Well, oh, I saw this get killed today, Ani. Isn't this like a Kathy Major Holding? Oh, I remember her coming on CNBC. It was literally right here, and Bloomberg, and she was asked if there was one stock you would recommend for everybody to own and put away, which one's your favorite? And she said this one, and it was at almost $50. So where is that? Oh man, $50 is up here. Okay, that's what she on Bloomberg, and this thing traded to $2 today. And her rationale, all it means is more upside. I don't even want to laugh because I wouldn't be surprised this thing one day, a couple of years from now, we see it at 70. It wouldn't be shocking. But I'll tell you what, if I owned it at 50 and it's at 2 right now, oof, right? If you liked it at 50, you gotta love it at 2. But yeah, that Cal's got a great point. It's new names. I know I sound like a broken record and you guys get annoyed because I repeat myself a lot, same shit, but it's new names. That's where the money's at. That's where the fun in the stock picking is at when you get out of this. You understand? They don't have to be new companies, but it's new names, new action, no overhead supply, nobody stuck in these stocks, right? The problem with all these names is everybody's buried in them. Every pop gets sold, every pop. So what comes out of these phases are just new names, fresh names. A lot of times, like you won't even know the name existed. I know what me, you'd be like, oh shit, what's this? What do they do? And you guys know who have been with me for years now. You guys know what I'm talking about. You see new names start to get accumulated, and we don't have a clue what they do. Even while we're buying them, we still aren't sure what they do. But they become the next net. They become the next NVTA, right? NVTA don't become the next NVTA. It's when nobody's in them and nobody's looking, all this happens. And then everybody gets in, Kathy pumps them, and now they're over here thinking about who they're going to kill. But that's when things in this game, that's when it becomes fun again. Right now, it's tough. It's tough. You got to put your trader cap on. Listen, some of you guys want, you like to be traders, right? You want to rely on those trader skills. Then it's a good experience, this market, because it's tough. But a lot of us like me, that's not really what we want to do. Right? We want to see aggressive sweeper accumulation in a new name that nobody knows, nobody's in, and buy some calls 3 to 6 months out, and then find out Starboard is taking a stake. That's the good stuff. And you know what's funny? And in this climate, you realize it, nothing is good, right? Like think about it. In a better climate, what do? We buy stock off flow. We catch an upgrade. That's what the sweepers had up their sleeve, or some news or some chatter. None of that exists in this climate. Okay. Even if you get an upgrade, your stock is not even going up off the upgrade. It's as useless as tits on a bull in this climate. You know, there's hardly any buyouts. Forget chatter, right? It's just a miserable environment. There's not a lot of opportunity in this environment for our time frame. You know, eventually we're going to be at a point where we could tuck some stuff away. Even, you know, some may think now you can start chipping away and tucking things away, you know, investor wise. But for our time frame, we got to be a little smarter than that. Yeah, the EV names, I don't know, guys. You know what I mean? They're just too hyped for me. They're too hyped. There's going to be winners out of them, I'm sure. Not all of them are going to go bust, but they just remind me of a lot of those, you know, hype bubbles. It resembles it so much. You know what I mean? Oh, for Nikola. No, you know what I mean? There's so many. That's the problem. There's so many, you know? So they're probably going to be what? A handful at best, a couple at best. Yeah, like you see this catches some decent flow. Like there's definitely a buyer in this. There's an interest in this name, but I can't buy this thing. You know what I mean? Somebody believes in this thing. But to me, they're all the same. You know, there's literally like 50 of them, right? Josh Brown believes. Blink, BE, LCID, Nikola, forget about even the more speculative ones, QS, all the SPAC ones. That's right, Presley. How many SPACs? You know, so those are real names, okay? The cloud names, they're real. Like a lot of them, I'm not talking about the Kathy cloud names, I'm talking about the real cloud names. A lot of them have ridiculous growth. Like it wouldn't surprise me those names come to life again. But QS, forget it. That wasn't that. I remember QS was one of my biggest winners, SPACs. I think it was QS. What was the symbol before QS? Was that the one? You know what's crazy? I think it was QS. It might have been somebody else. It was a different symbol before it came QS. Maybe it wasn't. But I made like $4 on the stock, almost a double in a day trade. And then it went up another 5 the next day, and I wasn't in it. Crack. That's it. That's the one. Thank you, Damon. Crack, something like that. KCAC. Oh, yeah, KCAC. That's the one. Yeah, the SPACs were fun. But, you know, it was like playing hot potato with those things. I was shitting my pants buying those things. You know, so that's the story. What else? Anything else you guys, especially you non-members, we're looking for an update? Oh, DraftKings, that's right. Like the story sounds so good, but take this damn mosquito, take the story and flush it later, Ani. Flush it down the toilet. Stories mean nothing. Look at this debacle. Look at this debacle. Do you know how many people was swearing that on every dip, this thing was going to be a major player? Gambling's not going away. Lucid. What was? Oh yeah, Lucid. I forgot. Lucid was like that was a hot symbol before it was Lucid too. It was like Churchill or something. CCIV, that's it. You know, Penn. Well, Penn's been around. You know, I remember Penn when it was just a racetrack. Penn was a decent stock, but the price action's still a debacle. Yeah, yeah. This is what's his face. Davy Day trader. Davy Day trader. My goodness. How many people did he bury? And I can't even blame him. I mean, come on. You know what I mean? Everybody likes to blame everybody else. You got to wake up. That was peak insanity. You're right. You're 100% right. And HC, that it bugs me out. If you look at a chart of, I think it's M2, money supply, exactly when the Fed closed the spigots off, right? Shut the valve for liquidity, right? Where M2 topped out, that's where these things stopped like a clock, right into the highs here and never looked back. I saw the China one. I saw. Some people are bullish. Some people think China is not going to go all in because of what the Fed has to do, which makes sense. So that should be interesting to watch. You know, in other words, is China going to be willing to pump liquidity while the Fed is doing what they're doing? It's kind of like losing proposition. Yeah, I know he needs to pump. He definitely needs to pump. They're in shambles. And that market's been in shambles a lot longer than ours. Like, look at this, okay? Look at this. So this topped down in 2021, all right? And think about our market right now, all right? Look at these rallies. You remember how many times this thing bounced and people thought it was the bottom? Yeah, China, as Trump would say, is the opposite of us. They're stimulating. They're stimulating. But the risk in China is what just happened to Baba. You understand? That's major risk. But at least you got the forces running over there. What do you think, Cal? These commodity names, you think eventually HC, those are the names I'm going to watch closely here. I want them to go quiet. I don't think they will. They already look decent. You know, this is a big move, though. I would like to see them digest for a bit longer than this. But, you know, if inflation, see, that's the thing. These things to do well, I don't think that bodes well for the market. I don't think that bodes well for the market. But you got the Oracle of Omaha buying with 3 hands, not 2 hands, 3 hands. Right? Like he's got a gift from the gods, Oxy. FCX, yeah, you know, FCX, I'm scared. I'm scared of everything. I'm a little sissy Mary right now. I'm scared of everything. You know, this scares me with FCX. Look at that chart. Look at this. How doesn't that scare you? You know what I mean? Like, and this thing can't bounce. Yo, this is copper, my friends. Okay? This is copper. Yeah, I saw that. You know, that's not a good sign right there. Now, you know, if it could stop here and hold this and build a little bit of a floor. That's crashy. No, Eric? That's a little crashy. You know what I mean? That's violent. Let's see. So you're saying it got to the lows, but it got there pretty quick. I see what you're saying. You know, like this took, look at this, ready? This took 4 or 5 years. Okay. This took literally what? A couple weeks? Like here. That's what it resembles. Here's 2008 right here. Right? So you know what I mean? It would could come down to there and still look okay. But doesn't it look like 2008? You see how most of the declines in this thing are more orderly than crashy. A copper, you know, that's not a healthy look for copper. It's not uranium. Yeah, look, I mean, it resembles 2008. All right, so if it was 2008, you got one more, that's a month. One more down month. I don't know, but I'm, you know, nothing looks good to me, guys. Nothing looks good to me. So you're asking the wrong one. I don't have a thing on my list that looks good. Not one thing. Huge cup and handle. What is this? Healthcare. Those look good. A lot of the healthcare names look good. You know, they've had decent runs already. This is was this cross-country healthcare? Interesting. Later, Lourdes, where's there was another one that was ripping. Oh, this one. This is another medical healthcare name, called a little flow. Later, small cap biotechs, yeah, but again, which ones? You know what I mean? I'd be careful. I'd be careful. Finally squeezed though, right? God, took long enough. You know, what are you playing the ETF, Steven? I mean, names are dangerous, no? Like, what are the names there? Isn't like NVTA a name in that? I think one quarter little action today, CRSP. There's one. EXEL, I know that name. Yep. So the logic behind biotech or even healthcare is it's recession proof. You know what I mean? The economy doesn't have a big effect on legitimate names. The speculative names that need to borrow money, if there are credit issues, they're going to get destroyed. They're going to get lit up as soon as there's some tightening signs in the credit markets because they rely on credit. But, you know, some of the more established names fare better in this market because they're recession proof. Look at the other recession proof names. Even like a Costco was doing better, right? Look at that thing come storming back. Dollar General. Look at, these are the recession playbook, you know? These small ones have been moving credit spreads. They move with credit spreads a lot, right, Stephen? Good call. Good call. It's worth keeping an eye on when you play those things. You're right. Good call. Even the small caps in general, they say. Once spreads stop widening out, small caps. Meanwhile, the Russell got a little hot lately, right? But right down to, I mean, look at that. How could we make much of this right here? I do think this could be the first to bottom when the time comes, but problem is GameStop is a part of it, which but yeah, there's healthcare biotech names. You know, some you got to chase here. That's the problem. That's the problem. Really, in Amazon? And now you got earnings with these things. What are you gonna do? You're gonna buy through earnings? Yeah, we'll see. We'll see how they react to earnings. You know, maybe they rally a little bit more, and then that's the end of the move. So we should be able to find trades in the interim, though. What else you guys got? Anything else before we wrap it up? All right. So listen, we got a lot to deal with anyway, as you know, as lopsided as positioning is right now, and maybe it opens up some opportunity. There's still a ton of overnight risk. You got earnings to worry about. I gotta check. I'm not buying it now, but I'll post it as soon as I get off if it is. You got earnings and you got Europe, right? Who knows how that shakes out? And then you're gonna have the Fed. But hopefully, you know, people will be hedged up going in. I don't know what the hell happens if they're not. If the opposite happens, I don't know what the hell happens then. No, the Fed's next week, right? Next week? I think it's next week. This is the ECB tomorrow, Europe. The Fed's next week, right? So like today you had that BOVA fund manager survey come out. People got a wind of how offside positioning was, got people a little bulled up. You know, you had a little, you know, constructive price action from the June low. But now we got to dodge, you know, some Europe and other shit now. So, but if you can day trade, there's some opportunity. Today, I didn't do that great today because of had to chase. You know what I mean? My best days day trading is when you see the market red and you see a legitimate squeeze, there's a shot that I had a decent day. But a lot of times if the market's green and just goes, you know, I'm scalping at best and I'm lucky if I make any money. So I'm hoping for some weakness and we'll see how that turns out. All right, ladies and gents, remember, have some fun, take it nice and easy. Earnings are a debacle anyway. All right, trade a little and we'll see how the week shakes out. Hopefully we could put in a little floor to trade off of in the meantime. Have a good night, everybody. Always a pleasure. Thanks for stopping by, guys.